just want to say hello and welcome you to the Risk Readiness webinar. I'm Ann Adams. I'm a product manager for business solutions at the Risk Management Association. RMA is proud to make this presentation complimentary to our members. If you're not a member, please go to RMA and explore everything that we have to offer at rmahq.org. Today's webinar is the latest installment of Credit Trends in Commercial Lending, Credit Risk Navigator, presented by Tom Cronin from AFS. So during the presentation, if you have any questions for the speaker, please submit them using the Q&A feature at the bottom of your Zoom screen, and we'll address as many of those questions as we can at the end of the presentation. So at this time, I'd like to turn it over to Tom Cronin from AFS. Thank you for joining us, and thank you for your patience.
Good morning or good afternoon. Ann, can you hear me?
Yes, I can.
Okay. So again, thanks, Ann, and good afternoon or good morning to everyone. Again, apologize for the technical difficulties. Today, we're going to be looking at the June 2023 data. And next to the year-end review, which we do in January, this is my favorite webcast, as it gives us a good look at where we are halfway through the year. So today you'll see a number of charts where we compare June 23 versus December of 22. But before we get going on the data, I need to switch over. I'm going to try to switch over to the dashboard to ask a question. So give me a second here. Okay, so this is our CRN dashboard. And later on, we're going to have a poll question regarding the recent interagency CRE statement. And specifically, that statement was the policy statement on prudent commercial real estate loan accommodation and workouts, which was issued on June 29th. And we received a question asking us if the CRN dashboard, which you see here, can be used to comply with the new policy, specifically as it relates to the market conditions requirement at the state or local level. And yes, it can, and I wanted to show you how we do that. So here we're on our executive summary page, and we're looking at non-accruals. And what I want you to focus on, if you would, is not so much the bank, but as the market. And you can see here the market in the highlighted here, the middle chart, lower left, market's 0.8. And so we wanted to give you an example, say, what if somebody's looking at offices in Massachusetts? So what you can do with the Credit Risk Navigator is go up and find under collateral, I'll find investor-owned real estate and specifically office. And if you watch now, if you remember, we were at 0.8, the chart on the lower left down here, you now see that overall for offices, the yellow, the market is 319. So well above the 0.8%. But again, we wanted to look and see what's happening in Massachusetts. So to do that, we'll pull up geography, come down to the USA, Northeast, and I'll get Massachusetts. And I'll hit apply. And you'll see in a second that the 3.18 will change. The blank is actually up the top. That's what's happening with that individual bank. But now you see the market itself. So this is the overall market for offices in Massachusetts is 1386. So if you have property type office and it's in Massachusetts and you're looking to see what's the market doing overall at the state level, which is one of the things that it says, the policy actually says relevant market conditions, particularly those at on a state or local level. You can use CRN to see what's actually happening in that given area. Okay, so I'm going to go back now and start with CNI. And a quick definition, these are business purpose loans. When we say CNI, business purpose loans to borrowers with annual sales north of 1 million. The loans are facilities. These loans or facilities are manually underwritten and risk rated. So mask or default only are not in here. And loans secured by owner occupied buildings are CNI. We distinguish that, pardon me, from CRE later, which you'll see later on. Excuse me. So before we get going, we wanted to launch a poll. So Ann, if we could have our first poll question.
We're going to cross our fingers considering the technical difficulties that have happened so far.
Here we go. So this is, what are your expectations for delinquencies and non-accruals or loan performance for the rest or the second half of 2023? And you have one choice here is what we want you to do. The first is performance should remain along the same lines as the first half, not much change. Second would be if you expect performance will improve versus the first half. So if you think your non-accruals and delinquencies will go down. And then the last would be you expect higher past dues and non-accruals. And we'll wait a second to see what everybody thinks.
Yes, the answers are still coming in, and we definitely have a larger participation this week as well. So give it a minute or two. Okay, great. I will end it and share the results.
All right. So 44% about the same, only 3 think it'll be better, and 53 would be worse. All right. That's interesting. Particularly, I thought worse would have been higher. This is actually kind of comforting to see that. All right. So now we'll get into the results. And here we have percentage of loans, our service trend, CRN service trend for delinquencies, 30 to 59, and then 60 to 89 days past due, and then non-performing. And when I say non-performing, I mean 90 days past due and all non-accruals. And let's start with the short-term delinquencies, the golden line, if you would. You can see that this rate has always been very volatile. Pardon me, even more so in periods of economic or severe economic distress. Our June number is slightly elevated versus the end of 2022, but surprisingly, we're about where we were a year ago. And after spending most of 2020, 2021, 22 above 0.5%, we now seem to be holding steady a little bit below that in the 25, 15, 25, 30 range. So again, there's some volatility, but it seems you can obviously see it's calmed down quite a bit. The non-performing level, however, has responded to the economic uncertainties a little differently, particularly lately. Last month, it jumped up into the 0.60s, and it's inched up again. In June, we're at 0.66. And we're going to take a closer look at what changed on the next couple of slides. So in this slide, we're showing the absolute changes in percent non-performing over a 6-month period. And you're going to see a number of charts like this today with the absolute change. So let me take a minute to explain exactly what I did. For each chart that's labeled absolute change, I took the percent NPL, or whatever measure you'll see later on. And then the calculation is December 22 minus June 23 for each 2-digit NAICS code. So for example, if you look at ag, the first result, first column on the left side, ag was at 4.52% in December. It's now at 3.26. So that's a positive change of 126. So that's how you read this one. And you can see that the declines in performance are slightly higher than the improvements, but the changes really are minimal for most sectors with a couple of exceptions. Those being the exceptions being, as we've highlighted here, first with the green arrow, agriculture, which had been having a lot of problems, actually rebounded quite a bit. It's still the highest non-performing at 326, but it's done much better. 56 admin, which you see has an improvement here. That's also still high at 1.63, but there's improvements there. And then the big deterioration that we point out, the biggest one was 32 manufacturing. It was 0.68, it's now 1.57. And so we thought we'd take a little closer look at that because that went almost twice what happened with educational. So let's take a look at 32. And once again, we're looking at the absolute change. So December minus June. And a negative result means that the non-performing loan for June is higher or worse than what we saw in December. And in CRN, we have the ability to go down to the 6-digit NAICS. Here, I'm just at the 3rd digit. And you can see that most of the negative change for 32 was due to problems in the plastics subsector. And if you think about it, there's been a lot of environmental push to get away from plastics. I know I was in a store in Maryland recently, and they said, you know, you can't get a bag here anymore as of the next month in a plastic bag. So that seems to be part of the reason why we're seeing a problem with plastics. And then I got to thinking, we're looking at manufacturing, and one of the things we've always talked about in these webcasts is manufacturing being a bellwether, or, you know, kind of a general economic condition. So I said, well, let's take a look and see what's happening with all manufacturing. And if there's problems here, that usually means there's some economic unfavorableness coming on. So I went back to when COVID first hit in June of 2020. And that's what you see here, the 4 points, June of 2020, 21, 22, and 23. And we've plotted the percent non-performing for 31, 32, and 33 with the solid lines. And then the dotted lines are the trends, again, for each one of those. And basically, after a good result for June of 2021, all 3 sectors had declined the next 12 months into 2022. And then 31 and 32 have continued to decline as we go into 23. 33's experienced a bit of a rebound. But the overall trend for these would signal that perhaps we're in for some economic troubles. So in CRN, for C&I borrowers, geography is based on the location of the borrower, not the bank's headquarters. So for instance, a loan to FedEx would be listed as being in Tennessee. And again, this is the change in non-performing December minus June. And there are 2 very obvious changes. The improvement for the Eastern Midwest, there on the far left, and the deterioration for the South. And the movements for the other sectors are really very minimal. And it's the drop in the South that's outweighing the improvements in the Eastern Midwest that's causing the overall decline in percent non-performing. So I thought it'd be better to take a look at actually what's happening in the South. So let's move on to the next slide. So here we have the percent non-performing for each 2-digit industry sector located in the South region as of June 2023. This is not a change. This is just the actual percent non-performing as of June, so a spot value. And this funnel chart sorts things high to low, with agriculture being at the top at 7.5%. And what I found most interesting about these results was that if you look at the couple of top sectors, you see all 3 manufacturing subsectors are there in the top 3. All 3 are actually in the top 6. Again, that's something that we've seen in the past in the recession, that when the manufacturing starts to go, you can pretty much have a feeling that other things are going to go along with it. So this is something we're going to take a further look at as we go along. Last month, we switching gears a little bit, we had a series of poll questions that asked what dimensions were important to you when you were managing your portfolio. And one of the most often dimensions was collateral. So I'm including this chart on collateral this month. And in CRN, we have over a dozen types of collateral, but on this chart, I've combined the types into just 3, so you can a little bit easier to see. The one in the middle is unsecured. The one on the left is secured by real estate, pardon me, and the one on the right is secured by non-real estate, which is mostly accounts receivable and inventory. And we're showing the absolute change for each And two quick comments about this. The biggest drop is for loans secured by real estate. Pardon me. And we'll look at specific property types a little later on, but this is the first of many indicators of trouble with commercial real estate lending. And the biggest improvement is for unsecured lending. And this sort of makes sense when we ask banks about their unsecured lending. It's usually reserved for their best clients. So you wouldn't expect them to have problems or non-performing issues for those type of clients. All right. So now we're going to go on to credit quality, and we'd like to launch our second poll. So here we're asking, again, kind of a forecast. What are your expectations for credit quality for the second half of 2023? And usually when we talk about credit quality, we're talking about risk ratings. Where do you expect your risk ratings, overall risk ratings, to go? So similar to the first poll question, single choice, you expect credit quality to remain about where it is. Second would be you expect improvements in ratings. So that would be loans that are, say, risk rated 4 would be 3s. And then last would be you expect the overall risk ratings to rise. So those 4s you think will go with the 5s or 6s or even into criticized. So again, just pardon me, your overall feeling of what you're expecting to happen here. All right. So 33, about the same. 2 again, and 65 to get worse. This is about what I expected. I think very interesting that actually just a couple people are expecting improvements in rating. So I think everybody's pretty much saying it's going to stay the same or get worse. Okay. All right. So now let's look at the weighted average trend and a quick explanation of how we got to this chart in case you're new to us. When a bank joins the Credit Risk Navigator service, we map their unique borrower risk ratings into the RMA 10-point scale. And on that scale, loans to borrowers rated 1 through 6 are tagged as being pass. Loans to borrowers rated 7 or to 10 are criticized, with 7 being special mention, 8 substandard, 9 doubtful, 10 a loss. And you can see that right before COVID hit in early 2020, we were at a service low. We'd recovered from the recession and the energy crisis. We were at the lowest point we'd ever been with Credit Risk Navigator. COVID almost immediately pushed us close to 5%. We never quite got there, but we were close. And then for almost 3 years, we've been improving, getting better than that 5%, getting back towards the service low until recently. And now we're starting to drift back up. We're not back to the COVID high, and we're nowhere near the recession high. But if you view risk ratings as an indicator of credit quality, we're definitely headed in the wrong direction. So I want to take a further look then at the loans that are rated on the low pass and special mention criticized, get a feel for really what we think might be under distress. And I use the term distressed here as what I call distress is loans to borrowers risk rated 6 or higher. So the low pass loans, which are the 6, and then all the criticized, special mention, etc. And the reason I add 6s into this is because we did a lot of CCAR work prior to COVID, and we know that a large percentage of 6s matriculate into percent criticized, somewhere in the 20-25% range on an annual basis. So if you want to see what's either bad or about to go bad, distress sort of covers that entire gamut. And I think this is possibly the most revealing chart we have today. Of the 24 NAICS sectors, 2-digit NAICS sectors, 19 had an increase in their distress levels December versus June of 23. Some of them not very much, but you could see some substantial changes here. This trend is even more alarming on the next chart, but here the results are basically saying that the credit quality outlook in face of the high rates, inflation, and other economic uncertainties is very unfavorable. And I think based on the poll we just had, most people would agree with that. Actually, 2/3 of you are saying, things look like it's going to get worse. So I don't think this is much of a surprise. So as I said, this chart shows you it's even more severe. This is our last CNI chart. This is distressed by absolute change in distress by geography. And again, this geography is based on the borrower. And you can see some of the other charts. If you remember, I had deterioration and improvement, and there's no improvement here. Every single region is forecasting, if you would, higher losses or less credit quality. Some of them areas like the Northeast and the Mid-Atlantic and the South, some severe deterioration. As a matter of fact, the South is the largest here. Their percent distress is 27.6%. So most of their, quarter of their loans, they're thinking it might go into criticize as we go forward. All right, so let's get started with CRE. We'll go into CRE now, and here's how we define those borrowers. We follow the interagency guidance, which basically says if more than 50% of the loan is to be repaid from the proceeds or the sale or the rental of property, that's CRE. This part of the bank's portfolio is frequently referred to as investor owned. And we wanted to start with our last poll question here regarding CRE. And as Anne launches that, I'll kind of explain what we're looking at. So as I mentioned early on and showed you with the example, the new interagency guidance came out in June. Says that you had the ability to rework your deals, your real estate deals. So we wanted to see how frequently you've been working out these deals, restructuring, work out, however you want to put it. So there's 3 answers. The first would be we've restructured a very small percentage of our loans. I put here less than 2%. It could be, a handful of loans. The second is we've accommodated a number of loans, somewhere between 2 and 5% of the portfolio. Again, just, it's kind of a guess. And then the last would be we've restructured a large percentage of the CRE portfolio, substantially more than 5%. So we'll wait a second to see what people have been doing. All right. So 73%, very small. 22, about half, and 4. So this basically tells me that not much activity has been happening in terms of CRE restructuring at this time frame, which probably doesn't surprise me given that the guidance just came out a month ago or so. All right, so we'll look at the CRE data. So the same measures of performance here as we have for C&I lending. The dark line non-performing is 90 days past due plus non-accruals. And then delinquencies, the gold line is 30 to 59. The green is 60 to 89 days past due. And we're seeing a similar pattern or trend for CRE as we saw for C&I, especially when you look at the non-performing results. Post-recession, we had a vast improvement. You can see the drop. And then COVID hit, we had a run up and subsequently a recovery, similar to what we had with C&I. And now we're sliding, or as I like to call it, leaking back up. And the delinquencies are continuing to fluctuate as well. And on the next couple of slides, we'll take a look at some of the property types to see exactly what's happening, why we're slipping back up. So again, this is our absolute change in percent non-performing, non-performing by property type. These are the 8 major property types that are in Credit Risk Navigator. And when I say major, I'm referring to loan balances. Pardon me. So lodging, which we've outlined or highlighted with the gold star, has improved quite a bit. Continues to gradually improve. In December, it was at 5.55%. It's now at 3.82%. Still the highest property type or the worst property type, but it's improving. It's coming back. But unfortunately, the lodging improvement is being offset by the continued decline of office. And I'm sure that's no surprise to anybody if you pick up the Journal or read American Banker. In December, the percent non-performing for office was 1.04. It's now at 3.2%. And if you're with us last month, we had documented how one bank had saved about $6 million by pulling back office lending. But as you can see here, there are a number of other banks that have not done that and are experiencing quite a bit of problems. And it doesn't look like these problems are going to stop at any time soon, as the office vacancies continue to decline, as return to work seems to have stalled around 50% if you look at the Castle system numbers. So credit quality, and once again, this is the weighted average risk ratings, and CRE is mirroring C&I. The little bump there in the middle for COVID, and then the recovery, and now we're starting to leak up again. You can see, a little tail here at the end on the far right. And in fact, we're starting to get close to our COVID highs. June's weighted average risk rating was 5.14. The COVID high was 5.18. So all the recovery we made, we're losing that. And so a couple of thoughts to conclude with this chart. We'd asked 2 pages back, how bad can office get? And here's an example of what you might expect. So again, this is the absolute change in percent distressed, distressed being loans low pass and criticized. And the change in distressed for offices, highlighted there on the right side, went up almost 15% from 32% to 46%. So if you think about that for a second, that means that almost half of the office loans are in or are near default, or at least into special mention. So that's quite an outstanding number. Some of that, I'm sure, is just abundance of caution, but still, even if half of that is going to default, that's a large portion of the portfolio. And I know this is a lot of analysts' concern. The other thing, that I'd like to point out are the multifamily and industrial numbers. Multifamily changed a little over 10%, June versus December. Industrial changes a little less than 10%, but say right around the 10%. And everybody's obviously been focused on office, and it looks like maybe we've forgotten about multifamily or industrial, or maybe in addition to office, you need to turn your attention to multifamily and industrial. The reasons I've heard from talking to the banks that some of these apartments and then warehouses are having problems. On the apartment side, there has been a substantial number of inventory coming online, and the ability to charge rents in face of the covering the inflation cost. It's costs more to build apartments, but you're not able to raise your rates. That's led to some issues with apartments. And on the industrial side, the e-commerce boom that we experienced in the middle of COVID has kind of slowed. And I think you've seen or read, where a number of warehouses that were being planned have been stopped, or just an oversupply. And again, with the issues with inflation, although the numbers seem to be getting better, The cost of building these buildings and then financing them has led to some issues with the industrial properties. Lodging is still the worst at 49%, but office is getting close at 46, just to mention that. So that's June. At the end of the webcast here, you'll see a survey. Please, if you take the time and complete that, I'd appreciate it. I use that to make sure I'm giving you what you need. I want to make sure that the data that I'm supplying is worthwhile your time. I also wanted to mention that next month we're going to have an extended demo of the Credit Risk Navigator dashboard. I did the little demo earlier. Several of you have asked to see more of the dashboard, and we're actually going to start with that on the August data. So August 31st is our next webcast. We'll probably spend 5 to 10 minutes showing the Credit Risk Navigator dashboard. So I want to let you know that up front. All right, so I'll send it back to Ann.
Thank you, Tom. And I think we do have a couple questions, so let me get to that. The first question was, is this unit based? So this was earlier on in the presentation, so I'm not sure about the reference. Tom, are you able to?
I assume that if it's unit, they're talking about maybe the number of loans. Everything that you saw here today was based on balances, so dollars outstanding. So if that's not the answer to your question, you see my email here. If you want to shoot me an email with exactly what you're looking for, I can respond to you.
Great. Then we have one more. So this one, do you feel that the new interagency guidance will lead to a higher level of non-accruals? The examples provided seem to indicate non-accrual in the most instances of a restructure.
So we think actually the opposite. A colleague of mine, Doug Skinner, and I both talked about this when we saw the guidance. It basically lets you take loans that, if you let them run their course, would end up being on non-accrual. But you can go in, subject to certain conditions, restructure those, give them a more favorable rate or longer terms, and keep them off non-accrual. So we think that this is going to be an issue for determining actually how the credit quality picture is, the true credit quality picture, because you'll be able to go in and in essence, a loan that would default, you can structure it so that you can ride it out for another 5 years or so. So we think actually the opposite.
Great, thank you. We actually did get one more coming in. So can you explain why the delinquencies do not track non-performing, why that happens there? The NP is impressively volatile.
That's a great question. And I wish I had a logical answer. In dealing with some of the banks we've had, one of the things that I'll say two things that have been proposed for why you see differences between delinquencies and non-accruals. First of all, is the 30 to 59 day delinquency rate. A lot of times really is an administrative issue. It's not a true credit issue. It's somebody didn't get the renewal paperwork in, or the appraisal was late coming in, especially recently with all the problems that are going on in terms of appraisals and people like that. And then the second is that there's and we've pretty much documented this. I'm not sure if Brad's on the line. Brad from Commerce, Brad Cunningham from Commerce is, in looking at the data with us, one of the things he said was, if you look at it, it looks like at the end of every quarter, everybody gets serious on collecting past dues, and they kind of let them go in the non. So, like July and August, nobody really cares. September, when you're going to report your quarterly numbers, you get serious about it. So that's another factor that we see happening. So between those two, the 30 to 59 being administrative, and a lot of bankers not really, I won't say not caring, but the emphasis comes in at the end of the quarter. That's why you're seeing some of these differences between those two.
Okay, I think this last one's more of a comment than a question, just feeding off of your answer there. Just that as a long-term lender, it is because credit managers overreact.
Okay.